Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
Okay, everybody was talking about today. What the heck just happened to the stock of Workday? It's the cloud software company, helps businesses with human capital management and financial planning. How did this stock plunge more than 8%, particularly because tech had a nice reversal? Okay, last night Workday held its financial analyst meeting alongside their big Workday Rising user conference. They rolled out some 3-year financial projections. Wall Street didn't like them. If you looked at these targets in a vacuum, I think they're terrific. Tons of companies would kill for these numbers. But everything in this business, as you know, is relative, and relative to Workday's previous guidance, some of these new forecasts were incrementally worse. For example, rather than growing subscription revenue by 20% plus, they're now talking about growth in the rate in the high teens. That's not what anybody wanted to hear, hence why the stock got obliterated. Unfortunately, the forecast overshadowed what I thought was a lot of very interesting AI-related product announcements we got this week. So, what do we do with Workday here? Let's check in with Neil Bushry. He's the co-founder, chairman, and co-CEO of Workday, and Carl Eschenbach is co-CEO to get a better read on the situation. Gentlemen, welcome back to Mad Money.
Hi, Jim. How are you?
All right, guys, let's go right to it. I can't ignore the fact, Neil, that it was the worst day in quite a few years for Workday stock in response to your new 3-year financial targets. So why don't you tell us some of what it was incrementally worse, no more than that. What are some of the main assumptions that made you feel like you had to guide a little bit lower?
Well, I'll start by saying that, we're all facing an uncertain economy, and we just wanted to put forth projections that we believed were achievable and dealing with this uncertainty. And Carl can get into more of the detail.
Yeah. So first of all, how you doing, Jim? We're proud to be here from our live on the floor at our user conference called Rising. We have more than 15,000 people here with us this year. It's more than double, Neil, than what we had last year in Orlando. And we've rolled out a whole bunch of new technologies. There's lots of partners, lots of customers. There's a lot of energy. And to your question, specifically, yesterday we did have our financial analyst day, and we shared with them a 3-year, what we call a 3-year durable model. And that 3 years shows us growing the business at 17 to 19% over the next 3 years. And to put that in perspective, Jim, this year alone, we're growing 18% on the top line. So we're saying even as we scale from $7 to $10 billion and beyond, we're going to continue to grow at the similar rate that we're growing this year. And by the way, it's a very profitable business. And if you look at what we've achieved so far this year, Jim, at the end of Q2, we actually raised our guidance both on the top line and the bottom line as we headed into the second half of the year because we see strong momentum and demand for our products and technologies.
Well, now, Carl, I think a lot of people don't realize when you have a trade show like Workday Rising, these are not just for show. You are actually winning some business. Now, I can't ask you to give up customers' names, but what are the verticals that you feel like you've really made great inroads on in the last 48 hours?
Yeah, well, as you know, Jim, we do go to market and we focus on specific industries and verticals. Some of our most exciting verticals is financial services, healthcare, government, state and local government's a big driver for us, financial services, and many others. So we definitely have a strong, robust business, and it's very diverse across many industries. And here this week, we've rolled out a whole bunch of new solutions, both on the HR side and on the finance side for those verticals. And I can tell you the excitement and energy is off the charts here in San Francisco this week.
Well, I think it's terrific. And I got to tell you, and Neil, one of the things, you were the first person to say this, and I read all about AI. You were the first person to say, listen, it's expensive up front. You got to understand, this is not a cheap thing. And the reason why, it's really hard to do is that there's a hit at the beginning. But you also explained the payback. But could you just explain what people should start understanding with AI is that there is a cost associated to it that's higher than what normal business is?
Well, so just taking a step back, I think AI is as important and maybe as disruptive as the cloud was. Workday was a company born in the cloud, and I think AI is that scale of importance from an innovation perspective. Different than the cloud, these large language models that AI are based on, they require massive amounts of compute to build the models and train the models. And so there's an upfront cost that we all just have to recognize. I think those costs will come down over time, but it's a heavy investment. Workday is making those investments. And the reason we're making those investments is we think these technologies will bring huge competitive advantage to our customers. both in terms of better automation, better insight. We're not trying to replace people. We're trying to augment what people do in a very thoughtful, ethical way. So this technology is really powerful, but it is expensive.
Okay, so Carl, what is the co-pilot advantage of your AI and ML for managers that you speak to?
Yeah, well, listen, we have a great co-pilot story is driven by Gen AI for both HR and finance. We showcased a number of these innovations yesterday during our keynote. We called our innovation keynote. And I think we are going to make our managers much more effective and efficient. For example, you no longer have to write a job description. You no longer have to write, if you will, a career growth plan. That will all be automated for managers and reducing their time, right, from writing to actually having those important conversations with their employees.
Well, okay, that's a great point, because, Neil, you're talking about Workday users create 30 million job descriptions. Now, you could waste days of time. And how much can you get that done with AI and ML?
You know, I think you can take hours. A process takes hours to take it down to seconds to minutes. It's massive. And it's not the work that people like doing. They don't like writing job descriptions. If the AI can write it for you, why not? It frees you up to do more important work.
Now, I always have take on, and Neil's probably sick of me saying, but I think universities, which have had just an abysmal record of trying to keep tuitions down, horrendous, that you are the only force that I have ever seen that is actually driving the cost of tuition down, and you keep winning colleges. What are you doing right that makes it so tuition's less?
Well, yeah. On the product side, we've been focused on higher education almost since day one, and it goes back to my co-founder, Dave Duffield. He's been involved with building systems for higher education since the late 60s, early 70s. We started Workday. The first thing we did was make sure that the HR and financial products, which do cut costs relative to other technologies, bring down the cost. But then we built a student system specifically for higher ed that is both dramatically better use for the students and administrators, but also at a much lower cost.
See, I think that's amazing, and it's so important because it's going to cost $100,000 a year to go to college. That's not right. We got to stop that. Look, I want to thank both these gentlemen, and you heard what he said about the slowing growth rate is not really going slower, okay? It's a new benchmark. It's a good benchmark. People kill for it. Carl Eschenbach is the co-CEO of Workday, and Neil Bushry is the co-founder, chairman, and co-CEO of Workday, and I hope he still comes on the show. Man Money's back after the break.
Coming up, as FinTech fumbles, two big payment players look mightier than ever. Do MasterCard and Visa hold the best hand? Find out next. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.